Hello and welcome to Talk Financial TV. On this recording, we will take you through a very brief verbal summary of our summer 2012 newsletter, simply called Financially Speaking. Financially Speaking is our quarterly newsletter aimed at our clients and website visitors, which outlines a brief summary of economic events from around the industry and around the world that we feel may be of interest to you. In the second quarter of 2012, very positively, we saw the Irish state, the Irish government, dip its toe back in international capital markets with the successful raising of €500 million worth of Irish government bonds at a very respectable yield of just 1.8%. While that's very positive, we must remember, however, that relative to the government requirement of about 20 billion a year, clearly €500 million is very small money, albeit a move in the right direction. We must also remember that the terms of that loan were very attractive, whereby the debt is only on a 3-month term. So therefore, we should not get too excited and think that we have recreated international capital market confidence in the Irish state. We don't believe we have. In fact, I think that we will be still well into 2013 before we can rely fully on international capital markets to finance government debts and government bonds for future capital requirements. Nevertheless, it is a positive step in the right direction, albeit a very small step. In the euro area, we saw Greece and Ireland vote in effect in favour of the eurozone, the euro currency, and in favour of austerity. Many people on the ground still are suffering enormously, but on balance, both populations from both countries seem to have supported the concept that we should not be spending what we do not have. Overall, that's more than likely a positive outcome, but it has not resolved the problem of pressure in banking institutions across the Eurozone area. Enormous money is leaving Spain as we speak, and the Spanish banks will undoubtedly have to be fully recapitalised. 100 billion, in our opinion, probably will not be enough. Spain have asked the Eurozone area for 100 billion. We don't believe it will be enough, because Spanish banks are obviously much bigger and a much greater population in Spain than there is in Ireland, and therefore we believe Spain will need more money. As you speak, Cyprus has also asked for help, albeit only at the smaller end of the scale at €1.5 billion, but that may well only be the start of it as well. So between Spain, Cyprus, Ireland, Italy, Greece, Portugal, there's clearly an awful lot of work yet to be done in the Eurozone area. The Irish property market is still on the decline, having fallen by a few percent in the past 3 months generally, although there are signs in certain areas in Dublin of price stabilisation. However, there's also downward pressure on the rental market in general, and if you leave Dublin to one side, with downward pressure on rent and still an oversupply of property units generally, we are probably not yet quite at the bottom of the downward spiral. Having said that, there's obviously a very strong market of people willing to buy property once the public feel that those prices have bottomed out, and once the Irish banks get back into lending mortgages in a practical and fair manner. So therefore, we would feel that once property prices start to recover, they will probably recover a little bit faster than inflation, based on the build-up of an oversupply of willing buyers. Once finance becomes available for them, we will probably see significant movement on property at the lower end of the scale. But having said that, we're still certainly not at the bottom of the property market in Ireland yet. But there are signs that we're not too far away from it. Investment opportunities, as we had predicted, deposit rates are now starting to fall. ECB has cut its rate to its lowest ever at just 0.75%. And Irish banks, particularly AIB and Bank of Ireland, have in the last 2 weeks cut their saving deposit rates anywhere from 0.2 to 0.9%. We said in our last newsletter that the relatively high interest rates of about 5 to 5.5% over 4 and 5 years on fixed term deposits will not last much longer. It seems apparent that we are correct and that those rates are now about to stop. So if you do have money on deposit which you do not require immediate access to, and which you do not want to have exposed to the greater investment markets, we would suggest you consider availing of 2 and 3 year deposit rates now, before those rates fall back. In relation to General advice: we are being asked regularly at the moment by people, should people retain cash euro deposits, or should they buy sterling and dollar? There's no fixed answer to that, and it clearly depends on your own personal circumstances. But we would say in general that, as a guide, if you require access to cash, either to live or as a backup plan for your own personal finances, then regardless of the risk inherent in the euro currency, you need to keep the euro currency, because you need access to your money. Make sure you keep it obviously in an Irish bank, one which is covered by the Irish government state deposit scheme. Equally so, if you're making plans over the next 6 to 12 months to make any significant investment purchases, for example, if you're considering buying property, buying a car, paying off a loan, setting up in business and so on, we would again suggest that keeping your money in the euro currency is the lesser of two risks. We also have to remember that buying sterling or buying dollar does not mean that you're not taking on risk. You're now taking on the risk of that currency, and you're taking on the exchange rate risk of bringing that currency back into the euro in time to come. Indeed, even if the euro were to ever collapse, you're then taking on the risk of bringing that foreign currency back into perhaps the Irish punt. That would more than likely go in your favour based on devaluation of currency and so on, should that ever actually happen, but that would be a one-off benefit. So if you require access to money in the short-term future for living expenses, for cash flow, or for purchase of property or otherwise, we would say hold on to your euro in the euro denomination with an Irish bank. If you have money that is more freely available for investment generally, then we would certainly say to consider diversifying your investment portfolio and your pension funding, whereby you're not only exposed to eurozone currency or to eurozone stocks and shares and property. And certainly having a balanced portfolio outside of the eurozone would not be a bad idea at all. Indeed, the global economy could and is showing signs of recovery outside of Europe, proving the point yet again that the world economy does not necessarily need Europe. BRIC countries, which are Brazil, Russia, India and China, are all doing quite well. North American equity is doing quite well. The Dow Jones, as we speak, is up at around 1,600 points. It's up at around 12,500 points, which is about 15 or 16% off its all-time high, indicating that North American equities are within reason holding their own at the moment. And therefore diversifying your investment portfolio between the BRIC countries of Brazil, Russia, India, China, Asia generally, perhaps North American equity, there are certainly opportunities in there. But we would not suggest for a moment that you have no exposure to the Eurozone as an investor. Whenever the Eurozone restabilizes, and at some point it will restabilize, there will certainly be investment opportunities for those people who are in early. So our message to the investor is, by all means, diversify away from the Eurozone countries, but not entirely. Finally, we'd like to thank everybody for having attended the successful launch of our website, talkfinancial.ie, in June of 2012 in Galway City. We had a packed audience in the Pillow Hotel, and our guest speaker, Jim Power, who would be an internationally recognised economic commentator and former advisor to several different public and private companies, was our guest speaker, and he spoke at length to an audience that were delighted to get his point of view in relation to what is happening currently and what might happen in the future regarding the Irish and the global economy. So to all those people who attended the launch of our website recently, thank you very much. Finally, thank you for tuning in to Talk Financial TV today and for listening to this verbal summary of our summer's newsletter, Financially Speaking. Again, if you'd like to get a hard copy, simply email us to info@talkfinancial.ie, or you can download a summary of our newsletter on our website, talkfinancial.ie. Thank you for listening. Bye-bye.